Hi, my name's Danu, and I'm the founder and director of Anandarasa Advisory. I'm working together with Forward Path Advisory to bring a series of podcasts. And today we have John Morley. He's going to give us some insights into the property market as well as the broking industry. And I hope you look forward to it. Rads, you can kick us off. Hey.
Definitely. Thanks for joining us, John. John, tell us briefly about your background, your journey, and how you ended up running your own mortgage broking business.
So my background is in sales predominantly. Sales is what a mortgage broker does. I mean, at the end of the day, we have a range of products and we sell those to our clients on behalf of our suppliers. So I was in sales. I went to Mackay in Queensland in 2005 to open up a new office over there. And I did that. And when I'd finished after 2 years there, I decided that I was no longer going to be a PAYG employee. I was coming back to Perth. I was going to set up my own business, which I did. And that business was called Sales Builders. And the process behind that was that I was going to be helping small and medium enterprises with their sales processes and get their products to market in a more efficient way. I hooked up with a local business owner who I had some previous experience with prior to that. And he asked me to come along to relaunch a product that he had, which I did. And that was such a successful relaunch that he decided then that he wanted me to be the general manager of his company here in Perth, which I took on a 2-year basis, knowing in the background I still wanted to be self-employed. Over that 2-year period, we relaunched the product and we launched new products. It was very successful. And in that process, I bought a house in Perth. Now, a friend of mine belonged to a local BNI chapter, and he referred me to a mortgage broker in that chapter. Now, that mortgage broker came to my office. We sat there. We did all the paperwork that was required for the purchase. The transactions were seamless. The service was fantastic. And I bought that house. And I remember at the time thinking, what a great service she offered and what a seamless approach she had to what I was used to. And that was going into a bank, talking to the lending officer, or in the earlier days, the bank manager, and the problems associated with trying to get a simple loan. So in the back of my mind, I thought, well, mortgage broking is something I think I could do and I think I would enjoy doing, and then put that aside. A particular day in about a month or 2 or 3 months later, I was offshore with a client of the company I work for and doing some work for them. And I was waiting in their lounge on this oil supply ship that they were working on, waiting for my ride back to the mainland. And on TV came an advert from a Queensland mortgage broking firm that I thought, wow, that seems like the way into this industry. So I talked to my partner and we decided then that we would approach the company in Queensland. We decided to take on a franchise. We did the educational requirements required at the time to become a mortgage broker, and we started on our journey as a mortgage broker. And then the way that it's transpired since is that over the last 13 years, I have now ended up with a company called Mortgage Choice. Now, important to say at this stage that Mortgage Choice, the comments that I make today are my comments, only the opinions are my opinions, and have no reflection on Mortgage Choice at all. But the company I am now a broker with and own a franchise under is Mortgage Choice. The original home loan broker that came to see me was a Mortgage Choice home loan broker, and she's still in the West Australian office today.
Wow.
That's fantastic. That's full circle right there.
It is. And the influence and, well, the service that she provided, I mean, it wasn't about the Mortgage Choice brand. It was about the service she provided is what had a lasting impact on me. And that's why I'm a mortgage broker today.
And the experience. That's fantastic.
Exactly right.
And who are your clients? Who do you look after in your with lending?
Oh, I mean, anybody and everybody. So I've got, I've just had a loan settle yesterday for a commercial property through a client with a self-managed super fund. That's his 18th loan he's done with me in the last 12 years.
Wow.
I've got a couple in Queensland who have just about to settle on a construction on an investment property that they've owned for a while. They've done 16 loans with me in the last 12 years. So I've got clients in every state bar the Northern Territory and Tasmania, and I've got a client that the smallest loan I've ever managed to get for them was $78,000 for a block of land in the wheat belt. And
Yes.
the most expensive loan, I think, so far is about $2.5 million.
Fantastic.
So a widespread. First-home buyers, investors, downsizers, upgraders, you name it, they're all there.
Oh, fantastic. That's good.
John, I might start with a broad question, and it's sort of you've talked about your own experience getting a loan, sort of at the start of your career. So, do you consider that it's harder now to buy a property for your kids compared to when you did? How's the environment changed, and is it easier or harder?
The answer to the question is yes and no. So, if just to quickly go back, when I bought my first house, it was in 1982 in Perth. To get that loan, I had to go to one of the big four lenders, and I had to have a meeting with the bank manager at the branch. And the bank manager said to me, if for you to buy a house for $40,000, you need to have 10% saved in the bank. So what I want you to do is go away and save $4,000. And I'm going to give you a certificate today that says if you can save $4,000 in 12 months' time, I'll give you a home loan for $36,000. So that was my driving force then. Now, back in those days, I earned $25,000 a year. So to buy that house, and it turns out the house I bought was $37,000. It was a 3-bedroom, 1-bathroom house on 800 square meters of land, 20 kilometers from Perth CBD. So it gives you an idea of the difference. But I bought that house on a $25,000 income, so about 1.5 times my income to buy that house. This morning, I checked on that house today to see what its current value is, and it's now at $400,000, maybe $450 at a stretch. Assuming that somebody earns an income of $1,500 a week before tax, they have an income of $78,000. To buy that house today, they would spend about 5 times their annual income to get that property. So yes, from that point of view, house prices have gone up and wages haven't gone up to the same extent. So the multiplying factor is a lot greater. My thought, though, is that it's not so much about the house price, because if we look at the market today, there's a lot of cash still in the system and sitting in redraw accounts and sitting in offset accounts. And generally, Australian families are in a fairly good position with cash reserves, particularly coming out of COVID. The problem I see, though, is for a new entrant to the market is the security of employment. If they don't have a full-time job with a regular income that they can bank on every week, then it's going to be hard for them to get a loan. If they're working in 2 or 3 different jobs in a week on a casual basis, excuse me, it's going to be a lot more difficult for them to get a house. And from my experience, the younger you are when you start looking at buying a house, the more equipped you will be to get a house in the short to medium term. So it's easy now for people to think, I don't have enough income. The media are telling us you're never going to be able to afford a house anyway. So if you turn on the TV and you listen to the news or you read the newspapers, they all say we're not going to afford houses and it's not going to happen. Unless we've got full-time jobs, that becomes the issue. And I think we really have security of employment, and they leave because they want to leave. They don't leave because the wages aren't high enough or because the hours aren't enough. That becomes the main issue. And just a couple of other notes I made here on that, just to touch on. The other thing about income is there are more demands on our income than there were 5, 10, 15, 20, and even 30 years ago when I bought my first home. When I bought my first home, my priority was food on the table, pay the mortgage on a $37,000 loan, and pay my car payment. Today, if I was in that same situation, I would need to probably not pay the mortgage, but I've got to pay rent. And in Perth, the rent is likely to be higher than the mortgage repayment. That house I mentioned that I bought in 1982, the mortgage repayment's about $400 a week, and the rent on that property is about $450 a week. So when we look at paying rent or mortgage, we pay some car payments, we pay for our food. We also want to update our iPhone or our smartphone every 12 months. So there's another $1,500 coming out of our wages after tax. We want the latest gaming chair or the latest console. And we also want to go to Bali a couple of times, and we want to go out at dinner time and have some dinner. We might sometimes have breakfast and maybe an avocado on toast. So there's a lot more demand on our income than there used to be in the past, and that's putting the strain on people's ability to see the future. So therefore, they lock themselves in the present, and the present doesn't look that rosy from that point of view.
Well, that's a great point, and I think that leads on to my next question, really, because my question is, how high can interest rates go, and then is there enough buffer, in disposable incomes? And clearly that discretionary expenditure is going to have to cut back one way or another, and the things that you were just alluding to need to cut back. So, yeah, where do you think the interest rates are going? How high can they go, and what's that going to do to consumer behavior? And do they have enough buffer to service their loans?
Yeah, good question. So at the moment, as of yesterday's RBA announcement, the new cash rate is 2.85% and inflation is 7.3%. If inflation goes to 8%, which is what's predicted in the next few months, you can likely see the cash rate go to, say, 3.35%. And then if you allow, if you look at the cash rate today at 2.85 and a mortgage rate on an owner-occupied property, sub 80% loan to value ratio of 4.5%, we can probably see that rate going to 5 to 5.5% in the next few months. So what that means is obviously people's borrowing power comes down because the cost to service the debt goes up. But as far as buffer goes, when I service a loan for a customer today, and this is part of the requirements of any lender now, if their rate that they're eligible is 4.5%, they will be serviced at 7%. So there's already a 3% margin built in as a buffer to allow for future increases in rate. The problem is that in some cases, when I talk to new customers, particularly that are buying their first home, in order to get them a loan today, we need to close credit cards and pay them out. We need to pay out car loans or maybe consolidate them into the loan if that's possible, so that we can put them in a better position to borrow enough money to buy their first home. Now, when they buy their first home, they've already got a buffer built in of 3%. But if they then decide that they've got their new home, now they're going to go out and buy a new car, get that credit card they used to have, and maybe get another personal loan for a holiday or a wedding or something, then that margin is already eroded. So when rates go up, they have no flexibility left in their budget in order to meet the original commitment, which is the home loan. So my advice around that is that when you're buying a home, you make sure you're in the best position possible to afford the debt that you're taking on. Be happy that your job security is secure, and if it's not, that you've got an alternative plan, and don't go and start building up the debt until at least 2 years after you've settled into your new home and you've got an understanding of what's actually going on, because it's a different mindset. In addition to having a home loan to pay, even though the home loan may be cheaper than the rent you were paying before you got that home, you've now got to consider $2,000 a year for rates, $2,000 a year for water. You've got maintenance and repairs and all the other bits and pieces that you didn't have to make when you were a tenant. So make sure you understand what you're getting yourself into and prepare over the process of the next 2 years before you decide to take on new debt.
Thanks, John. That's good advice.
John, thanks for that. As you know, the cash rate, I think before May, it was at 0.10%, and currently the cash rate's gone up to 2.85%. And we saw a sharp increase within a short period of time. If you could advise RBA, what's one thing you would tell them that they're currently ignoring in their policy making?
So my thought around that is that there's not much we can do with the RBA, because their role is stability of the monetary system, if you like, to make sure the economy can continue to grow, but can grow at a pace that is a manageable pace, if you like, to control inflation or deflation, whatever the cases may be. There's nothing I could say to the RBA from my background that I believe would be worthwhile, other than to say that their messaging at the beginning of this year and the end of last year was that interest rates, from their point of view, weren't going to go up at least until 2000. What do we got now? We're now at 2022, 2024. So we weren't going to see any increases in rates until 2024. A lot of people bought property and renovated and did things in COVID based on that presumption that rates are fairly stable where they are. And in fact, we did a lot of refinancing in that time and got people into fixed mortgages where their rates were in some cases as low as 1.75% for 2 and 3 years. In fact, I remortgaged my properties at a fixed rate. So my rates don't convert over until 24 and 25, and they are now cheaper than what they are at the moment. So the messaging coming out of the RBA was rates won't go up. The media ran with that, and then within 6 months ago, that all changed. But it wasn't just a change Australia-wide, it was a global change. And my question is, how did they get it so wrong? And why didn't they know, or couldn't they foresee what was coming? And if they can't do that, what chance has the average person in the street got to manage their finances when that level of management, if you like, isn't available?
Definitely, I think they didn't actually predict the war in Ukraine as well, and that had some implication, and that played into the market as well. And another question that I also want to ask is, I think I think there's about $200+ billion of fixed rates coming off fixed term next year. How's that going to play into the market?
Okay, so what will happen there is that from a mortgage broking point of view, that's the time where those borrowers need to reassess their lending. So number one, they need to build a buffer up now to be prepared for what's going to happen when that rate does come off, so that they've got another 12 months of surplus cash available to meet their commitments in the mortgage. The thought is, and again, it's only a thought, is that rates will probably peak around middle of the next year. Inflation is going to peak in the next 12 months, and then rates will start to come back. Theoretically, people coming off of fixed rates in the next 12 to 24 months will come back into a better variable market, which will help to cushion the effect of that. But there's no guarantees, of course. So my thought is build a buffer up now so that when you come off fixed rates, you're not likely to refix because the rates are going to be too high, but at least have cash available to weather that storm and then reassess, talk to your broker, talk to your lender, and have a plan in place ready to go so that it's not a knee-jerk reaction on day one when you suddenly got to find an extra $1,000 a month to meet your commitments.
Do you see a downturn in the property market coming through in the next, say, 12 to 18 months?
Not in Western Australia. And in fact, I think supply and demand, so there is enough demand in the system to meet the supply available. So I can't see a downturn. I can see a softening of prices, but in Western Australia particularly, I don't think that's going to be, it's going to be within a matter of 1 or 2%. It's not going to be great, and it's going to bounce back quite quickly.
Oh, fantastic. And what do you consider to be a leading indicators for growth in property market? And what are some warning signs?
So the leading indicator will be population. So we're going to be bringing in 250,000 migrant workers in the next 12 months. We're going to, and that's only going to meet demand. That's not even going to meet the demand that we have. Those people are going to need somewhere to live, and that's going to put a stress onto the rental market. The problem then is the risk factor, of course, is that people at the lower end of the income scale will no longer and have no longer got security over where they live. And there are a lot of stories now where investors or landlords are saying, unless you can find another $50 a week or $100 a week, you can't be living in my house. And there's plenty of people out there with the income to take on that rental, but the people that don't have the income that can fluctuate with demand are going to be on the streets, and that's going to be our problem that we need to handle.
So, John, can you perhaps tell us a little bit more about how you think brokers have transformed the lending market, and what you see their role to be, and how have they ensured competitiveness for the everyday consumer?
So, interesting enough, generally broking started in Western Australia. It was one of the first states to use brokers, and back in the early 1990s, a broker basically went to a bank and said, listen, I want to promote your product. And the bank said, if you can send me a lead, essentially, we'll pay you $400. And that's where broking sort of started. And over the period of the 1990s through to the 2000s, the industry grew where brokers allowed access to the market for non-major banks. So as I said earlier on, if you wanted a home loan, you needed to go to one of the big four. By the end of the 1990s, into the 2000s, there was a wider range of lenders, including banks such as Suncorp, for example, and ING and the like that sort of started to show up. The proposition that a broker brings to the market is that they allow for non-major lenders to enter the market and have a distribution network available to them. So when I got my first home loan in 1982, there were about 4 lenders I could talk to. There were building societies and all sorts of other organizations about, but the big 4 banks were the ones that stuck in my mind because I didn't have a building society account and I wasn't aware of them. Nowadays, when I look at lending for customers, I can assess around 30 to 35 different lenders to find products that meet their requirements. So what a broker does, they bring competition to the market. They allow other lenders to come into the market and get distribution without having branches. And history shows that a broker's effect on the market has probably been around 2% down on rate. In other words, if the rate was 6%, a broker came into the market, and now you could probably get competitive rates around 4%. So brokers have introduced that level of competition into the market, and that's where we move on from here. The other thing that's helped us, of course, being brokers, is that a lot of the major banks are closing branches, which means that there is now less access to a branch or to a bank than there used to be. So people are now saying where do I get my finance? I'll talk to a broker. And of course, COVID has had the effect of keeping people away from branches because we couldn't move around. So now they're going to brokers to fill that gap, and that helps to that competition. More brokers, more lenders, more serviceability.
Great. So you think definitely the perception has changed then of brokers, and people probably, do you think that people are leaning towards at least considering a broker first before going directly to a bank, or is it a bit of a mix? How's the perception changed?
So in 2000, when I started in 2009, we had 50% market share, brokers versus big banks. In 2017, it was about 57%, and today it is 69.5%. We've been up over 70% recently, so there is a far better utilization now of the broker market. People understand brokers; they know they don't have to travel far to get their loans, and the broker proposition services their needs. I think that's going to grow. In the UK, for example, the broker channel account for about 90% of all lending done. I think we're going to be heading in that direction more quickly than not.
Okay, that's really interesting. Some interesting stats there.
Thanks, John. How is the digital age impacting the broking and the banking industry? And what's your view on cybersecurity? Because I know since COVID, a lot more people are online, and they're emailing a lot of documents, confidential documents to their brokers and financial advisors. Can you talk us through that? How important cybersecurity is for the lending and banking industry?
Sure. So, as you say, technology has had a huge effect on our business in the last 2 years, particularly with COVID. And that's because we couldn't go to see clients. We couldn't collect information like we used to. They had to email it to us. So nowadays, with the platforms that we use, they run on bank encryption technology, so that and I'm not an expert in this in any way, but from what I understand is that the bank encryption is one of the strongest encryptions that are available. So customers can feel assured that their identity and their information is secure when they do load into those platforms. However, having said that, we know what's happened with HBF and Optus in the past, so we have to watch this space. For the first time ever, as part of my insurance requirements, I need to have cybersecurity insurance. I've never had to have that before. So that protects me, it protects the aggregator being Mortgage Choice, it protects the banks. We just need to make sure that the people that are running the systems behind the scene are really ahead of the game, if you like, as far as illegal activity goes. From now on, also, again, as a result of, the Optus situation, any information I've collected in the past on IDs, and there's a requirement for a broker to keep information for 7 years post the loan payout. Any information that I've collected now which contains photographic identification, I deleted from my own systems, and I just rely now on the bank systems, the aggregator systems, to store that information.
Thanks, John. Might change gears just a little bit. I'm interested to get your views on the younger generation and their perception of home ownership, and whether you see potentially, that could there be a shift in perhaps more towards a rental economy in Australia, or do you see the dream of owning a home still to be front and center of the younger generation?
I'll go back to some of my comments earlier, and I think that whilst people are financially stressed, and they're not financially stressed because they're not earning enough money, it's just that they are financially stressed because they are putting their money in lots of different areas. And I think that while people are spending the money as they earn it, they can't see the future, so therefore home ownership is not on their radar. The problem, of course, with that from their point of view is that when the time comes that they decide they want to own a home because that becomes a priority in their life, or they can't get a suitable rental property, they're not in a position then to get their head around how they do that. So I think that in Western Australia particularly, there are a lot of young people with a lot of income that are buying houses. That's not an issue. But there's also a lot of people out there that are saying, I'll never be able to buy a house and I'm going to stay living with mum and dad until I'm 30 and I'll just wait and see what happens. And that's a bit of a risk for everybody in their life's plan.
What is the first piece of advice you would give someone who's looking to buy their first property? And, how do they approach you, John?
Okay, so the first bit of advice, what would happen is that they will contact me either through our online advertising, if you like. They'll be referred to me by their friends and their family and the like. If they're just starting out, the first bit of advice I give anybody is go and buy a book called The Barefoot Investor by Scott Pape. And this guy's been around for 20 odd years now. The strategies that he has in his book will help everybody achieve their financial security over the course of their life. And I always refer back to a client I've got in Queensland who are mature age, they've got adult children, and they bought his book about 20 years ago and have implemented the policies and the procedures and the strategies that he implements he puts in that book, to the point where when I get statements from this couple, I get about a dozen statements, and those statements are what they call their buckets, and they are for rental house expenses, for fun expenses, for owner-occupied expenses, for wedding, everything is broken down into what they call a bucket. This couple at the moment own their owner-occupied house at $2.5 million. They are building a new house on a block that they have demolished the old house on. That house is worth $850,000. Their investments are worth around $2 million on their own, and they've followed Scott Pape's advice all their life from the time they started buying property. So my first advice is go and get his book, read it, understand it, and then implement those procedures and those strategies. Because I don't think if you don't do that, you will never have enough surplus cash to meet those big ticket items that you might aspire to down the track. After that, it's about understanding what you want to achieve. So if you want to buy a house, why do you want to buy the house? Do you want to live in it? In most cases, people say, yes, I want to live in my own house. And then you've got to consider, is the house 50 kilometers away from where you work? And are you prepared to travel 50 kilometers in each direction every day in order to do your job to go back and pay your home? So really think about the costs involved in owning a home not close to where you work. And if you still want to own a home, have you given consideration to maybe buying the home, but turning that into your investment property? And so staying with mum and dad, for example, and this is generally these conversations happen when the mum and dad are in the room. So it's about, are you able to stay with mum and dad if you want? If you want to get into the housing market, but you can't afford to buy where you work, then maybe you buy an investment property, which is a step into the housing market. And then when you've then got that sorted, you can use equity in that then to, when you sell it, buy your first owner-occupied home, or you can keep that house and use equity to purchase a new home, if that be the case. But it's a long-term plan. It's not just about what you're going to do in the next 6 or 12 months. It's about what you're planning to do in the next 5 to 10 years. That's how home ownership needs to be approached, to make sure you're making the right decisions. And then, of course, making sure that if you're going to get into a home, you've got job security. So are you a FIFO worker today, but you're going to buy a home because you're earning $150,000, and then as soon as you've got your home, you're going to move back to Perth, and you won't find a job that pays the same amount of money. You're likely got 80,000. Is that part of your strategy? What are you going to do to manage that? All these sorts of things, having a clear and concise strategy, having a plan, and budgeting for it so that you're preparing for that in the future.
And John, do you see parents also going as guarantors for younger generation? Do you see that coming through the market at the moment?
Yeah, absolutely. It's not as widespread as you might think, but where a parent or parents have equity in their property, then they, in many cases, will make it available, because the parent can, say, put up 20% of the equity, which can mean that their son or their daughter can get into their home without a deposit and not pay lender's mortgage insurance. The focus, though, has to be on paying down that home loan and using a combination of building equity through paying the loan down and growth in the property value, so that as soon as possible, mum and dad's mortgage can be released from that property, so that mum and dad can either go on to help another child that might be coming along, or that they can retire without the concern that they've got maybe $100,000 or $200,000 debt against their property that just won't go away. So definitely parents can do that. It's not that widespread, but it is available.
Definitely. Our last question, we ask all our guests this question, 2 questions. What is one thing you're excited about? It can be anything. It can be politics. It can be, mortgage broking. It can be anything. What is one thing that you're excited about in the next, say, in the future?
Well, I set this business up with my partner for lifestyle purposes, and those lifestyle purposes are starting to become realistic now.
Yes.
So 10 years down the track now, it's suddenly like, okay, if I want to take a month off and go traveling, we can do that. So I'm excited about my next 20 years of being able to travel around the world and have a nice time based on the work we've done in the last 10 or 15 years.
Fantastic. And the last question, as I said, what's one thing that frightens you?
Well, and again, it's general. So I would say that the world order right now. So I'm concerned about the effect that the China process is having on the global situation. Obviously, Russia and Ukraine, I think that's going to go away, not quickly, but it's going to stay isolated away from mainstream. But I do believe that China is our biggest threat as far as overall wake up in the morning and feel secure and safe that everything is going to be tickety-boo and that we can move on and do what we want to do.
Okay, fantastic.
Thanks, John. Really appreciate your time. Great to have a conversation. And yeah, hopefully we can, touch base down the track and have you back on.
Absolutely. I look forward to it. It was good fun.
Thanks, John.
Thank you.
Thanks, guys. Talk to you soon.
Cheers.